And I will introduce him quickly as I can, because he has a very, very long resume. So Professor Dr. Lawrence Souza has 26 years experience in commercial real estate and financial services. Prior to working with Pillar 6 Advisors, establishing Johnson Souza Group Incorporated, he worked for Charles Schwab Investment Management as a managing director. He was a chief economist, managing director, Global Real Analytics, investment advisor, Quantum Financial Network, Solari Investments, New York Life. Dr. Souza is a registered investment advisor, representative, and commercial real estate broker, providing economic and investment consulting services to retail and institutional real estate investors. Also held positions in strategic portfolio research and analysis, and holds graduate degrees in finance, economics, public administration, political science, and information systems, a doctorate degree business administration, corporate finance, has been teaching college level courses for past 21 years at San Francisco State Hayward, Golden Gate University, San Francisco State University, Santa Clara University, University of San Francisco, St. Mary's College. And of course, he is a CCIM. I could go on and talk about you another hour, Barry, but I would.
Please don't.
You have an impressive resume, and you are a returning guest to fiabci. So please take it away and introduce us to the current state of California and commercial real estate market.
Sure.
Thank you.
Well, let's throw. Thank you very much for the introduction, and always nice to speak to your group and CCIMs, and always love to work with Helen and Terry. Let's just put California in the context on a global basis. We're definitely ahead most other countries because of our strict vaccinations and our implementation of protocols. We have some of the lowest hospitalization and death rates, in the world, because of just the swift, approach that we took to it. It was a very concerted effort, and the benefits associated are starting to pay off. However, if you look at most of the major urban areas across the United States and probably across the globe, you're still looking at very low physical occupancy rates. You're looking at relatively high economic occupancy rates, obviously depending on the city that you're in. But really, the pandemic is probably the worst thing that we've confronted post World War II, other than World War II itself. And it makes the financial crisis look not insignificant. It was still significant, but this was double the economic and the fiscal impacts on a global basis. In countries like Latin America and Africa, where you have vaccination rates in the 0.01 range, I really don't see a concerted effort to actually be able to solve the problem unless there is a global effort, let's say a World War III effort, to try to get everybody inoculated and vaccinated before the new mutations start to emerge and break through the technology that we've already created. So it's really a moral, ethical, not only an economic and political issue, but it needs to be addressed as soon as possible. And it will continue to have economic effects on a global basis that will impact us here in the United States and definitely California. And I don't see it really being addressed the way it should be on a global basis, probably for the next 10 to 20 years. And there will probably be, in my estimates, by the end of, within 30 or 40 years, there will probably be 1 billion people that have died from the disease. So let's just put it, into some reality. California is definitely distinct between Northern and Southern California. Southern California seems to be in a better position because you have the ports of LA and Long Beach, but actually the ports of LA and Long Beach are now running 24/7, and the ports have started to find a lot of the shippers that are holding their ships offshore too long, and a lot of the ships that are being put at bay for 2 weeks are now being rerouted to Seattle and Oakland, which should increase demand for industrial and actually help support the economy in definitely Oakland in the East Bay and definitely in Seattle. There are multiple, I'm just going to keep talking, there are multiple opportunities in the Bay Area for real estate investment. We are starting to see significant job recovery. The unemployment rate is below its natural rate at this point, around 4%. Counties like Marin and San Francisco, San Mateo, Silicon Valley have lower unemployment rates than the state, but there are labor shortages that are actually hurting the labor markets, which is impacting the commercial markets, although the apartment market has always been one of the better markets here in the Bay Area and in Southern California, and you're starting to see rent spikes or at least rent recovery and valuation recoveries in the apartment sector. The office market is still wounded, both in Oakland and San Francisco, and if you go down to San Francisco, it's not boarded up like it was last summer, but it is slowly coming back, and I just don't feel the excitement that there was once pre-pandemic or last three boom periods in San Francisco. So it's going to be some time before we reabsorb the office market in the urban areas. The suburban markets have held up better and have seen better absorption as people flock and companies flock to the suburbs out of the urban cores, as the urban cores have deteriorated significantly due to crime and homelessness. And you can really see that in Seattle and San Francisco and in LA. One of the hottest sectors right now in the Bay Area, and I would even say in LA, but mostly in the Bay Area, is life science. And you can really see that in highest and best use readapting office buildings and industrial warehouse buildings in South San Francisco around Genentech and the airport, all the way down through Palo Alto and the 101 corridor into West Side and even East Side San Jose. The other sector that's really hot right now, but it's really hard for us to invest in, is data centers. You can invest in hyperscale data centers through real estate investment trusts. That market has done really, really well over the last 5 years. I think the data center REIT space did a 22% rate of return per year of the last 5 years. I don't think they'll probably be that high over the next 5 years, but if you just cut that in half, you're still looking at probably a 12% rate of return on your data center and potentially your infrastructure investments through the REIT sector until mid-scale data centers or micro data centers are deployed throughout these metro areas, which we'll probably see more of that in the next 5 to 6 years. Industrials held up really well and has actually been another darling sector, not only in the Bay Area, but in the South Bay and LA and up in Seattle. But the bottlenecks in the supply chain because of the disruption of goods coming out of Southeast Asia into the United States because we can't find enough truckers. And in Asia, they've had to shut down some of the manufacturing because of COVID. So our supply chains have been significantly disrupted. You have labor shortages in the ports and the trucking transportation industry, which is all flowing in to causing inflation. And I think inflation's probably the biggest problem that we're going to be confronting because we see it. We see it in labor costs. We see it. Inflation's running at 5 to 10%. Using the consumer price index or the producer price index, with the labor shortages and the supply chain shortages, it looks like the inflation is going to continue through next year for probably another year. And at some point in time, if inflation expectations actually are revised and the lower inflation expectations that were anchored for about a decade decouple, then we're going to probably see the Fed start to move in and start to raise interest rates. They've already said that they were going to raise interest rates starting in November all the way through to the end of next year. And if the yield curve inverts at any time within the next year, we'll probably see a peak in the stock market within 12 months, and we'll probably be in a recession within 24 months. So I'm factoring in a possibility or a probability of a mild recession in 2024. That's kind of my synopsis. How much time do I have? Because I can go to my slides and I'll just go straight to the real estate section.
You could have another 10 minutes.
Okay, perfect. I'm just going to go straight to the real estate piece of my presentation. Actually, I'm just going to hit on some stuff really quick. In the San Francisco Bay Area, one of the biggest factors driving demand for commercial space is venture capital. We saw this year and last year, not last year, but this year, some of the highest venture capital because there was pent-up VC funding that couldn't be done last year because of COVID. But we're seeing record venture capital flows, and the majority of venture capital flows in the United States flow to Silicon Valley. And if you throw in the Bay Area, it's about 50-60% of all venture capital raised in the United States per quarter comes to the Bay Area. And most of it's in internet and healthcare and telecommunications. So, follow the money is the way I see it. Look at the sectors that are receiving the majority of the venture capital, find those geographic locations in those submarkets, and invest alongside the venture capitalists because the VC translates into jobs. I'll talk a little bit about residential, and then I'll go to commercial really quick. You can see based on the Case-Shiller indices that the West, and particularly Northern and Southern California, have seen some of the highest home price appreciation rates. And as interest rates start to tick up, it'll probably cool off the market. Affordability is really low. Pricing is probably at its peak, but it's still continuing to appreciate fairly gradually. But you can really see like Phoenix, 20%, San Diego, 20, Seattle, 18. These are some pretty amazing home price appreciation rates we haven't seen since 2006, 2007. Industrial markets are continuing to see, positive net absorption rates, below structural vacancy rates, continuing price and rent appreciation rates, positive net absorption, which will continue. And here's the top markets for net absorption and rent growth: Dallas, Atlanta, Inland Empire, Phoenix, Chicago, Pennsylvania, Columbus, Houston, Central New Jersey, and Los Angeles. And if you look at rent growth, it's Salt Lake, San Antonio, Reno, Las Vegas, Phoenix, Columbus, Louisville, Atlanta, Dallas, and Inland Empire. Again, when I look at California, I really look at the region, the Pacific Northwest, and the Desert Mountain states. The West is the best. The Pacific Northwest is part of the whole region, and we face Asia, which is one of the fastest growing economies in the world. I'd rather be here than on the East Coast, although the East Coast can absorb a lot of capital, but so can we. And the logistics market is really hot right now. So if you want to invest in that market, just look at what Prologis does and follow the money. And you can look at what the top markets for logistics are: San Francisco, North Bay, Puget Sound, San Diego, Orange County, Long Island, Los Angeles, Northern Virginia, Oakland, and Austin. You look at apartments, again, positive net absorption, although vacancy rates are continuing to rise, but they still remain below the structural, which means that there's positive rent growth. We're seeing rent spikes in some markets. Cap rates are still low. Appreciation rates are still high, and demand for apartment complexes are still high. And it looks like the net absorption has bottomed out and is going to start rising. Some of the top markets for rent growth for apartments: Inland Empire, Sacramento, Ventura, San Diego, Portland, Orange County, Honolulu, Seattle, Oakland, LA, San Jose, and San Francisco. Actually, San Francisco, San Jose is negative, but actually they're starting to come back and starting to see a lot of price momentum and rent momentum in apartments. The office market, again, we thought we were going to start occupying this September. Looks like next September or the first quarter. Sublease space is starting to taper off. and starting to slow down. And again, some of the best markets for rent changes is really Paris, Berlin, Seoul, and San Francisco is starting to bottom out. And then retail is actually starting to recover because of the vaccination rates. Some of the sectors within the goods sectors are actually beyond where they were pre-pandemic. I think this market is bottoming out, and some of the top markets I would follow the migration, and that's going to be Phoenix, Atlanta, Houston, Dallas, Las Vegas, Austin, Orlando, Tampa, Charlotte, and Nashville. And then, these are the data centers and life science. The Bay Area is number one, along with Seattle and Boston. And I'm going to end it there because I know I don't want to run out of time and take anybody.
Oh, you can. I probably talk a little bit more. That's always such a fantastic information and great quality information that we don't find everywhere. Thank you for that, Larry. What about other industries like cannabis industry? We have a lot of it, and it's legal in the state of California.
I'm sure Helen can speak on this more than I can, but that market's still pretty hot. It's hard to find inventory, but it's hard to convert, existing, industrial space into grow space or distribution space. You really need to have the permitting, and you really need to have the community, and you need the political and zoning in place and the permits to be able to actually, deliver a product. Again, I see a shortage of space out there. I don't see that being alleviated anytime soon unless you have community support, political support, the zoning modifications, and the permits from the local jurisdictions.
That's a very good point. Is that well, I'm sure that the audience will have more questions for you very soon, and probably you and Helen will answer more questions, and you will talk more about the commercial real estate market in our area. But I would like to let Helen get into details after that. But before that, I would like to acknowledge our fiabci USA president. She's actually joining us here from New York, and her name is Eugenia Foxworth. And I don't know if you can actually let her say a few words, because I would love Eugenia to say a few words for all of us. And also our Los Angeles, South or San Francisco chapter president is here as well, Spencer Hu, and I'd like to salute him as well. Hello, Eugenia, and thank you for joining us.
Good morning, everyone. I specifically got up this morning to see this program. One of our members said, you cannot miss it. And that was about 3 days ago. I'm enjoying it tremendously. And Dr. Souza, thank you and welcome back to fiabci. Thank you all. I won't take up any more of your time. Have a beautiful day, and I will continue listening. Thank you.
Thank you so much, Eugenia. Thank you for your support.
Always. Thank you.
Well, back to Helen. So I would like to introduce the current president of the CCIM, Northern California, San Francisco, who you already met, Helen Chong. Helen, she's wearing so many hats, and she has such an impressive resume as well. Helen is the founder and CEO of the Halen Group, and is consistently ranked as one of the Bay Area's top producing real estate agents. Motivated by an early life of financial hardship, her primary aim is to help her clients achieve financial security at retirement. Helen moved to US from Hong Kong by herself in search for the American dream. She managed to graduate from UCLA with a degree in economics while working up to 3 jobs. She then became a pension fund analyst, But when she saw clients' pensions suffered during the dot-com bust, she began looking for something safer with better control. Her search was satisfied when she studied various strategies with real estate investment. Helen believes that real estate investment can lead to financial independence, whether as a primary residence or part of a broader portfolio. She advises her clients to make informed decisions that benefit their financial futures and strives to make the complex real estate process accessible to first-time home buyers and profitable for seasoned investors. She provides buyers with detailed property condition consultations and investors with extensive 10 years analysis for a better view of what the real estate can do for them. Helen's many certifications give her clients the edge no matter what kind of transactions you're looking for. She has the prestigious designation of being a CCIM, Certified Commercial Investment Member, held by only 13,000 other agents worldwide. She also is a CIPS, Certified International Property Specialist, and holds certifications from the Graduate Realtor Institute, GRI, Accredited Buyers Representative, ABR, and Accredited Staging Professionals, ASP, among others. Helen is an active investor and an avid volunteer. She currently serves as the president of the Northern California chapter of CCIM. She's actively involved in Santa Clara County Association of Realtors, which is Silicon Valley, for the ones who don't know what that is, and is an active donor for the Travis Manion Foundation. She has helped host and speak at several large networking and educational events, and she also authored a book. I don't know when she had time for that, and selected to be on a Forbes speakers platform. Helen is married to an Iraq War veteran and a mother of 3. She is fluent in Mandarin, Cantonese, English, and speaks Indonesian. That is very impressive, Helen. And what is the title of your book?
The title of the book is called Power to Change Lives. Actually, it's a book that documented my journey from Asia to America. But more importantly is that it involves around, like, all of us really are looking for home, but home doesn't mean like a physical structure, but it's also where we belong, where we feel like we belong. So for me, I found my home here in America. And then, but that also, of course, related to my real estate background and how I found real estate as a way for financial independence. So at the end, I added a little bit of investment advice. So it's a simple and easy read.
That is wonderful. And now ease us into the Bay Area and Silicon Valley commercial real estate.
Absolutely. Well, let me go ahead and share screen first. Here we go. And I'm going to hit %. Want to confirm with you guys that you can see full screen. I know it's loading. Can you see the full screen? Yes, great. Because I have experience before that. The entire time during my presentation, it wasn't full screen at all. So, well, thank you so much again for the introduction and also having us at NorCal CCIM to represent and also collaborate with you and share with your audience regarding the San Francisco and Silicon Valley commercial real estate market. I'm really excited about talking about this as the first thing I want to talk about is that a lot of people, probably it's a global news by now, it's about this California exodus. So I'm sure a lot of people are wondering if it's true or a myth. And I've been going to conferences, meeting people throughout the country, and everybody was talking about, hey, I heard a lot of people are leaving California. How do you feel about it? Are you going to stay? So these are some of the images you see when you turn on the YouTube channel. Everywhere it goes, that it makes your heart really kind of think and wonder if California is still the right place to invest. Now, let's look at some statistics besides the YouTube videos that we see. Let's look at the migration inflows and outflows. And San Francisco, actually, in the Bay Area, it's true that there's always this outflow rate of people, but it didn't just happen. It actually has been happening for decades or for years at least. So, however, we do have a lot of people moving in as well. So it's not just people moving out. There are still a lot of people moving in. And as a matter of fact, I do have quite a few clients who are moving into the area because of employment opportunities. So in a sense that, yes, we do have some outflow, but don't forget that we still do have a lot of inflow into the Bay Area. And as a matter of fact, in July, UC studies had come out and it said that, contrary to popular belief, residents are not fleeing California. And these are some of the key findings in this report. It says the majority of Californians still believe in the California dream. I mean, if you live here, you understand what that California dream is. And it's funny because we talked a little about how I came here from Hong Kong, 25 years ago. And when I arrived, I did feel like this is the California dream that everybody was talking about. And also, residents are moving out of state, but not at an unusual rates. And there's no evidence of millionaire flight from California. So they talk about a lot of wealthy people are leaving California because the high tax rate here. It is true. I do agree with that. The California has a lot of high taxes here, but it's not like there's these huge number of millionaires that leaving California either. And California's economy attracts as much venture capital as all other states combined. So let's take a look at the value of the venture capital investments in the US in 2020 by state first. If you look at this chart, you can see California basically attracts as much venture capital as all other states combined, as mentioned in the previous report. And also affluent Californians are the group most satisfied with the direction of the state and very likely to believe that it will be a better place when today's children grow up. So if you look at how much venture capital investment's been invested in California compared to any other states, you can see that there's still a lot of growth here and a lot of confidence here in California. So with that said, I know Dr. Larry Souza did mention a little bit of our unemployment rate, and then he did mention that our actually unemployment rate is among pretty low compared to the national rate. So San Mateo and Santa Clara counties actually had the second and third lowest unemployment rates among California. And for those who are not familiar, is that Santa Clara and San Mateo counties kind of consider part of the Silicon Valley. And then more north around Marin County remain in the #1 spot for the state's lowest unemployment rate, with a decline in September from 4.4% to 3.6%. And then now, with that said, with the unemployment rate being so low, of course, that everybody would talk about the office market. So what's going on with the office market and the Bay Area? So COVID, real estate, Silicon Valley office rents reached record heights during the COVID. Like this just came on not too long ago, a couple of weeks ago, especially for the South Bay office markets, actually showing some positive signs, according to Colliers. And if you, I think it's just about 3 weeks ago, Apple, not only they are building this mega office in North San Jose, they just bought a few more office buildings in Cupertino, where the headquarters is. So Apple is still continuously purchasing a lot of office buildings. And of course, Apple and 5 other companies, which include the Google mega campus, is building and has been approved around May, that they are going to move forward with building their mega campus and close to downtown San Jose. So Silicon Valley definitely has seen a lot of growth from the offices. And I didn't include it in here, but if you go to Silicon Valley Business Journal, and they actually have a map of all these developments of office buildings, very concentrated in around downtown San Jose area. We have the BART station, the second extension extending down to downtown San Jose. So you definitely can see a lot of growth over there, and then there's still a lot of confidence in office market. However, maybe it doesn't show it yet, that we still see vacancy has gone up about 510 basis points in the San Francisco metro area. And the rent decreased by about 9% for the San Francisco area. So I separated two out is because San Francisco is a little bit more north. That's most people from overseas, they know about San Francisco. While Silicon Valley, it seems like it's still a little bit newer concept about, oh, what San Jose. San Jose is basically the Silicon Valley down south. And San Jose metro area, the vacancy has gone up too, but it's only by 280 basis points compared to San Francisco area, while the rent did go down, but only went down 3.1% compared to 9% in San Francisco area. So as you see, that there's actually still the impact is definitely there for the Silicon Valley area. It's just not as much as the San Francisco metro area. And in terms of retail, when we compare, by the way, these reports, these statistics came from Marcus and Millichap, so I love looking at different brokerages, their market reports, just so that I can compare the differences. So I picked Marcus Millichap for the office and retail because it's easier to read compared to some of the reports. So depends on what I'm looking for. I go to different websites to find these statistics. Now, with retail, for the supply and demand in San Francisco, as you see that the net absorption rate is negative right now still. And then there's still, however, the vacancy, the vacancy is also going up. This is, of course, we kind of see that because of the COVID pandemic that has affected the retail market pretty significantly. However, what we are seeing is that the rent actually increased slightly this past quarter. So in the Q3 2021. So there's a sign of recovery there for sure. And in terms of San Jose metro area, which is the Silicon Valley area, the net absorption rate is not as significant compared to San Francisco. It's not the negative net absorption. So we are seeing also that the vacancy is a little bit more moderate. It's about 5% compared to San Francisco is over 6%. And the rent actually has gone up 1.3%. So it is also doing better compared to San Francisco metro area. And if you look at industrial, Dr. Souza had mentioned earlier, the West Coast has been doing really well. And you do see the highest increase in average rents for the West Coast area, especially if you look at this chart. Seattle is more the Northwest. They're doing not bad, it's 5.9%. The Sacramento is 7.5% increase in the industrial rent. And then Bay Area is about 5.9%. And in terms of Southern California, 6.6%, Inland Empire 8.2%, and San Diego 6.2%. So the green are the top 10 markets, and out of the 10, 6 of them are on the West Coast. So what about the Silicon Valley and San Mateo County? Again, this is more peninsula, closer to San Francisco. It's not exactly in San Francisco. There's more industrial data for the San Mateo County. So if you look at the vacancy rate, actually year-over-year change is down by 4.3%. And the forecast is also going to expect to come down as well for vacancy. And net absorption actually has increased by 1 million square feet. And then the rent is has gone up by to $1.23 per square feet. And in terms of San Mateo County, the vacancy rate has gone up to 6.3%, and the net absorption is negative 401,000 square feet, and the asking rent is about $1.71 per square foot. So as you see that Silicon Valley, in general, just now we talked about the office, retail, industrial, they all seem to do better than the San Francisco area, but then the rent is still higher compared to Silicon Valley. So this is kind of interesting because we do see a lot of movements in the Bay Area where San Francisco has a lot of, coming down a little bit to the Silicon Valley. But I always like to talk about commercial real estate. I feel like you cannot really separate out the residential because they, in a way, especially with multifamily, they are kind of tied together. So I'm going to share with you guys a little bit about the residential market as well, since our company does quite a few residential transactions as well. And then our bread and butter is really about multifamily. So here is some median sold price for single family homes in different counties within the Bay Area. And we look at Alameda, Contra Costa, Marin, Napa, San Francisco, San Mateo, Santa Clara, Solano, and Sonoma. The one of which that you won't pay attention to is the Alameda County. They are more East Bay. So again, I wish I have a map here, but then for those who are not familiar, East Bay is, well, obviously since on the east side, and then Silicon Valley is on the south, and then on the west side is more the peninsula and San Francisco area. And during this COVID, we definitely have seen a lot of movements going from more expensive area over to the east side Alameda County area. So that's why you see the change in the price is 23.8%. And another one is the Santa Clara. Santa Clara County is more the Silicon Valley area down in the south, and it has gone up 16.2% year over year. And then also, if you want to compare with San Francisco, it's 5.1%, which is a little bit more. San Francisco definitely got hit really hard during the COVID, and we saw a really significant change and also the demand over there. However, I want to assure you that it has recovered quite a bit. The sales year over year change is more positive now, but Marin and Napa has gone down by 39.2% in terms of sales volume compared to the last year. So these are just some of the numbers for you to see. And I thought it would be interesting to also note this. If you're from another state, you might be a little bit shocked. It's like, wow, your median price in September 2021 in San Mateo County is close to $2 million. It's 1.975, while last year it was at 1.77, and Santa Clara County is $1.6 million as median price, and San Francisco is still really high up there at 1.75. Now this kind of explained to you why Alameda has become so popular, because in comparison, their median is only 1.3, while last year was at 1.05. That's why there's such a huge move towards Alameda County. And of course, the pricing has gone up so much. A lot was due to the interest rate. So this is just some mortgage rate projections that we track every few months. And Freddie Mac, Fannie Mae, Mortgage Bankers Association, and National Association of Realtors have their own projections. And for 3Q 2021, it's passed, and it was average of about 3.1%. And then these numbers here, what I'm showing you here is basically talking about what they have adjusted from last month. And before they were projecting that, 4Q is going to be about 3.1. Now Fannie Mae's dropped down their projections to 2.9. Freddie Mac still staying at 3.4. Mortgage Bankers Association dropped from 3.4 down to 3.1. And National Association of Realtors at 3.3 still. So the average is about 3.18. And et cetera. It's like for 2022, 1Q is at about 3.33% for mortgage rate. It's 30 years, by the way. And the 2022 2Q is 3.45, and 2022 3Q 3.55. Now, not saying that these numbers won't change or the projections won't change, but at least you can see that from these organizations, their projections have been quite moderate from 3Q 2021 to next year, a year later. We're just seeing about 45 basis point increase only in terms of mortgage rates. So that's the residential side. I gave you a quick update for California, or I should say Northern California. But now there's some regulations that came out recently. It's that Governor Newsom abolishes most single-family zoning, not all, but most single-family zoning in California, which is called SB 9. It allows up to 4 units. You're allowed to build up to 4 units on a lot of these single-family lots. So this report came out, this news piece came out on September 17, which was last month. And so that absolutely created a lot of, some people don't like, but then this is one way that Governor Newsom is saying that they can resolve these housing supply crisis that we have here in California, because of course the pricing has gone up so much, mainly due to the supplies being very low. And the way they see it is that if we can build more units on each lot, then we're able to increase the housing supply. Now, will this really truly solve that housing supply issues? I guess we will have to see, and maybe we can ask Dr. Larry Souza and see what he thinks later. Now, in terms of multifamily, if you look at this, it's a CBRE research, and you see that multifamily is still the most popular investments for a lot of investors. If you look at the way they bid in terms of pricing, 34% they're willing to bid above asking price still, even with this pandemic, even with the eviction moratorium. We have so many buyers asking for multifamily, but there's just no supply no supply on the market. And even with eviction, again, with eviction moratorium, with tenants are not paying rent, sellers still have this expectation that they need to get top dollar because of cap rates being really low, and also they see that as a temporary situation that can be improved in the long run. So in order for our clients to even bid for multifamily, they still have to bid over asking, or about 58% you don't get any discount, and then 6% get small discount, and then this is so minimal that get only mid discount. So if you are investing in multifamily, I know it doesn't sound like it makes sense, but it is what it is right now. But logistics, which is the industrial, you see that 57% is still willing to bid above asking, and 41%, almost all of the transactions, no discount at all. And of course, unfortunately for office stabilized office, is 59%. They all have a small discount, but less than 10%, and 11% of those have mid discount 10 to 30%, etc. And I think that the biggest hit, of course, is the shopping mall. Here is the 59%. They get over 30% discount during the transaction, and then 2% of those 10 to 30%. So this kind of gives you a good sense of what our investors are investing in right now. And from Black Knight, they have this great report to show the markets, the serious delinquency rate in the different markets. Because when we look at serious delinquency rate on the mortgages, that's when we know how the market is doing, right? And I think a lot of people were worried that, hey, we're going to have so many foreclosures and the market is going to crash. But if you look at ranking from all 50 states, 50 metro areas, San Jose ranked last, meaning they have the lowest in the serious delinquency rate. San Jose is the Silicon Valley area, and even San Francisco is ranked 45. So they are really, when our clients ask us, hey, can we find some foreclosures? The answer is always, no, sorry, we don't really have any foreclosures. We can't really find any foreclosures on the market. Oh, sorry. One thing I wanted to mention is that the report is that the tech hubs, especially in San Jose, San Francisco, and Seattle, continue to be among the least impacted during this COVID pandemic. And in terms of the historical sales volume, of course, you see this really, the sales volume was the greatest was in 2019, but then it had dropped down significantly in 2020 and 2021. East Bay, it's across the board. It doesn't matter which East Bay, San Francisco, and San Jose, but especially in San Jose, you see that the number of transactions has dropped down quite significantly. And this just kind of like another, this is more the Bay Area and Taipei area apartment sales statistics. So in terms of dollar volume, you now see that 2.3 billion compared to 7.1 billion. And we are back down to about like 2008 level, which is only about $2.3 billion. So again, if you are multifamily investors, just be patient. It does take a longer time to find the right investment for yourself. And now here, look at some of the different markets in Northern California in terms of the asking rents. Good news is that almost every single market has been going up. The trend has been going up, but we do see a huge drop, especially again, go back to San Francisco. We saw over 22% drop in their average rents at the time. Same thing for San Jose, it had a huge drop, while East Bay has a moderate drop. And then you look at a lot of these more outward suburban area, they have actually gone pretty stable, especially Sacramento area. It didn't really drop, it just continued to rise. And then the rise finally is slowing down a little bit. A lot of Central Valley area, they're all doing pretty well as well, like Modesto, Stockton, and the Vallejo area. But in San Jose, you see that in July, around July, August area, it has gone up, and then it kind of come back down a little bit. And same thing for San Francisco. I think the main reason is because at first, a lot of these large companies were talking about everybody's coming back to work around September, even if it's not full-time, it's still part-time. So people were coming back to rent, and then all of a sudden Delta variant hit, and then they said, okay, never mind. You know, everybody wait until probably 2022 February for you to come back, and that's when you see the demand for apartments in terms of tenants drop a little bit, and then the asking rent has dropped a little bit. But I mean, it's very obvious that you can see the rents increase when the office, like really, just kind of like what the Dr. Larasuza was talking about. You know, depends on the variant and how we are controlling this COVID situation. If the office can come back and reopen for employees to come back at least part-time, you will see that the market will increase and improve. Now, in terms of cap rates, of course, cap rates is the main valuation vehicle for commercial real estate. And then in San Francisco, 5+ units apartment building sales, this is what the cap rate trends has been like. It's about 4.6 to up to 6% cap in 2011 that has been coming down. But then, you know what, actually we had gone up slightly to 4.4, around 4.4% in the San Francisco area. But of course, we can still see some of the area of 3% cap, and they do perform at 4.5%. So, but at least we know that the cap rate has been pretty suppressed right now, and then that's why it helped increase the property value in the area. And Marco Cugia, he's the Associate Director, Market Analytics for CoStar. And I asked him basically, like, what do you think the cap rate is going to go afterwards? And then he thinks the cap rate will likely be flat in the near term. And also Aaron Frederick from Collier, he's the Executive Vice President Multifamily Investments, and I've done businesses with his team before. And he did say that he sees so much capital flush into the multifamily sector because of its predictability compared to other sectors. Cap rates will continue to level or even go down slightly. Almost done. Just a couple more slides is regarding the California eviction moratorium. It ended on September 30th. That was a big thing. We were probably the last state to finish or end our eviction moratorium. Everybody was really worried about, oh my God, what's going to happen to the tenants? Are they all going to be evicted after this is ended? So San Francisco, they did have a plan to extend the eviction moratorium through end of 2021. I don't think it had passed yet, and but there are actually hope for tenants and landlords who are actually impacted by the by this whole COVID pandemic. For those who really need help, California got the federal funding of $5.2 billion towards the rent relief funds. And as a matter of fact, I track this pretty often, every couple of weeks. And as of October 19, I should say, as of October 19, there was only 17.3% funded so far. There's still a lot of money available, that they still need to fund to those who are in need. So there are $4.5 billion have been requested, but then the funding actually sent out and helped those people still going up pretty slowly, but it is there. And then hopefully a lot of people will be able to get help through our California rent relief funds. All right, lastly is that multifamily market from Yardi Matrix is that gateway metros is from their report. Gateway metros are recovering quickly with substantial month-over-month rent gains. San Jose 3.6% leads the whole entire country, followed by Boston 3.2%, New York 3%, Miami 2.7%, San Francisco 1.8%, Chicago, Washington, D.C. both with 1.5%, and Los Angeles at 1.2%. So this is interesting as you see reports after reports that they're talking about the tech hubs in Silicon Valley area, basically in our Bay Area, has been doing pretty well, and then the forecast of our economy is actually not as bad or as grim as some of those reports been talking about out there. All right, that's it. Hopefully everybody's still awake.
Wow, no, Helen, this was great, and actually it touched on a lot of aspects of commercial real estate, is what I was thinking. And we invite our participants to ask questions via chat or question and answers. We're here to monitor. But what I wanted to mention is that that's interesting, but there are certain trends in commercial real estate that happened already pre-pandemic, like the retail, for example, or even offices, and they were accelerated by the pandemic. And another conclusion is, of course, being here in the Bay Area, of course, major players in the tech and biotech sector continue to invest, in commercial real estate assets. Because they also had very high earnings during the pandemic. They saved a lot of money. They came up with a lot of products. We all know how many companies went public during the pandemic and how many newly minted millionaires we have in the Bay Area, here. People who saved a lot, on staying home, on not traveling, and companies saved alongside with them. So of course they will continue that because they have projections on long-term projections on 10, 20 years. We're not going to be in a pandemic forever. So life will continue eventually. So of course, if you're in a market like that, and if you're a company like Apple, of course, you're going to continue to build offices because at some point you will need them. And the retail, unfortunately, and the entire downtown San Francisco, for example, will have to be reurbanized, and you will have to rethink it, completely. But this is the case with most cities in the world, or most cities like San Francisco that has a destination downtown financial district, for example, which functions because of office workers who show up there for work, and then they will, have lunch there, and they will use the offices. That hasn't happened. So of course, you're going to have a part like that of the city that's affected, and it's kind of decoupled for the rest of the city, or from the city life as we know it. And on multifamily, it's also interesting because everybody's talking about how low our cap rates are here, and they are, indeed. But we have other metrics, and it's always a good investment. And I wanted to mention that for the first time in a long time, and we've encountered a lot of vacancies, entire multifamily buildings vacant, with tenants who left voluntarily just because they life changed and they didn't want to pay high rents, and they moved to other states during pandemics. Their work didn't require them to be physically in the Bay Area, and they moved. So for the first time, the multifamily investors have the opportunity to start from zero and to have the tenants that they want. They're unencumbered, just because San Francisco, for example, and Oakland have very, very strict tenancy laws, and tenants are protected, and they have a lot of benefits here. So this is also a benefit. I see it as such.
Yeah, I mean, you're absolutely right. It's like, for those who are not familiar with our area, California, we do have a statewide rent control, but then the statewide rent control is really not that bad. Really, if you look at it, it's the CPI plus the inflation. The 5% plus the CPI. But then some of the cities, the local cities, will be San Francisco, Oakland. They have much stricter rent control, which you really can't raise rent. So for those,
I think Santa Monica too, and I think Santa Monica as well in Southern California. Yes.
Yes, and Los Angeles, and San Jose too. But the restrictiveness in San Francisco, Oakland are probably more well known, right? It's like if you have an empty vacant building, you're worth a lot more than having tenants, long-term tenants in the building.
That's right.
So it takes some strategy.
Let's think of that. Yeah. How important that is, just because if you think, oh, okay, I'm buying a vacant building, and in this market, it's hard to find tenants, and the rates are going to be adjusted, of course, with the situation. And I would say most of my clients and the projections for rentals were a little lower, 20, even 25% in San Francisco, for example. But again, you have an unencumbered building, which is great, from that aspect. And I'd like everybody to understand how important it is when they're considering investing in multifamilies in the Bay Area.
Yep. Definitely. I think multifamily, again, mentioned earlier, is just the supply has been very, very low. The sales volume is super low. And so, you know, it takes a lot more effort to find those multifamily investing. And we get a lot of these questions all the time from investors like, why are people investing here? And Bay Area is so expensive. But it's that a lot of us people see the future value of the property. And maybe I can ask Dr. Souza, because I think a lot of people are expecting that inflation is going to go up quite a bit too, with the supply chain blockages, with the money supply in the economy. And we are expecting the inflation rate is going to go up. And that's why this has been fueling the commercial real estate market as well.
Yeah, it's, I mean, luckily we're in an asset class. You know, we're well, probably industrial. I wouldn't say necessarily retail or office, but when you have the CPI adjustments embedded in the lease contracts, and you're putting, when you're upgrading the building through your capital expenditures, you're putting in inflation, using inflation adjusted materials. There's a somewhat of a hedge, you know, of commercial real estate with inflation, but it's not a perfect correlation. But my concern is at some point in time, you know, the cost structures, you know, which they have gotten really high to be able to have the supply respond to the market pricing. And then the other biggest concern, my big concern, is if, you know, inflation inflation expectations do decouple from the low levels, you know, that have been in place for over a decade. If people start to readjust, you know, their inflation expectations, they're going to be looking at higher rents, higher costs, definitely higher interest rates. And those higher interest rates, if they move up too fast, you know, too far, could create a shock within the not only the stock market but the bond market, which will obviously trickle into the real estate market. So I really watch what the Fed is doing. I watch short-term interest rates because that's what they really control. And when that yield curve starts to flatten, and if it ever inverts, that's when the sirens go off.
Yeah, that's definitely something to watch. The inflation is something worrying everyone, and yeah, we'll see it definitely in our commercial and in the real estate market. I wanted to mention for everyone who doesn't you know, understand our geography. So San Francisco Bay Area, it's about 100 miles, you know, around. And that's more than 7 million inhabitants. It's very easy for us to move from a city to another. When we refer to East Bay to South Bay, this is in relation to the San Francisco Bay, which it's very easy for us. Again, as I said, we move easily. It's not unusual for us to go for dinner from San Francisco to Napa or for San Francisco to San Jose. It takes 1 hour. It's not a big deal. Again, we're Californians. And we cannot decouple one region from another. They are very interdependent. They are functioning together. And we see real estate customers, buyers, sellers moving fast between one area to another, from San Francisco to Berkeley or to Oakland or to San Jose. It's really as easy. And this is how we move around, you know, usually. And especially during this pandemic, as Helen was mentioning in her report, we've seen a lot of residential real estate buyers moving into areas where they could buy more land and more space. And that typically it's not San Francisco. We are not building single family homes anymore here. And the recent legislation that just passed and Helen showed, it's restricting that. The state of California is trying to solve the housing crisis. And for that, they're encouraging building multi-units. And that's why we don't have a lot of single family homes. It's considered a luxury. Therefore, you pay premium for a single family home. So that's what I wanted to mention for everyone, you know, that it's wondering how we'll look at things. But yeah, San Francisco in itself has less than 1 million inhabitants. San Jose has 1 million. but the entire area, which is very dense, has 7 million, and we're just moving from a market to another with ease.
Yeah, and then there's so many different markets that we can actually invest in the Bay Area. We always think about the Bay Area is, of course, it's metropolitan and the cap rate is really, really low. But then if you go out just an hour away from Oakland towards east, and that's like a suburban market and or tertiary market, or even I call it emerging market, where there's still room to grow, and the cap rate is a lot better compared to the Bay Area. So technically, I always tell our clients like who are looking both California and out of state for cash flow purpose, you don't really need to go that far to out of state. You can still see it or find it in California.
There are a lot of things I mean, definitely there are a lot of opportunities in the Bay Area. Just, give it a chance. We are promoting it here. I think that both Larry and Helen have been wonderful promoters of our, local real estate market. But this is not a local, this is a global market. Just because everybody is watching us, everybody's watching what's happening here. So we are, I would say that of very high relevance within a global, real estate investment opportunities field, and into large schemes. So if there are any questions, Eugenia, do you have something for us as being a New York, a broker, one of the top brokers in New York, in Manhattan, and then in Harlem and Brooklyn? So how is your market there?
It is a very unusual market. It's really either we have the empty buildings and they're still building, which where I live right at Lincoln Center, and there's one building behind that they've been building, they stopped building. They did not do an implosion. They just lowered it one at a time. 3 years, it's been empty. I mean, nothing has gone on. They did the foundation. But meanwhile, they put up 2 new buildings on 60, if you may know, near 61st and Broadway. The commercial market in Manhattan is like New York. They say we are unique within ourselves. That is our commercial market now. I was hoping that they were going to do something with the hotels that were vacant, that they put the people that were in shelters in, because right now insurance companies are calling me to see if there are any spaces available, because people have the flooding and the homes. It's like with Sandy, I see Dr. Souza bowing his head. They won't do it. So I think we need to have CCIM contact our government people in New York City, because you seem to be on top of everything. But that's all that I can say. Yes, they're selling apartments for $45 million still, but yet they're having trouble selling apartments, which is the medium range in Manhattan, for $800,000 for a 1-bedroom. So you tell me, I don't know. So I'm glad I joined you, and I found this very interesting, and it's things that I did not know. And Elena, I think that both of the panelists have helped me tremendously, especially since I do have investors, and that's what I'm looking for. Places for a couple of people, as Helen will know. A lot of the properties in New York are predominantly people who do not live here that are investing. And now I have another page. And thank you all very much.
Thank you for being with us, and thank you for the East Coast perspective, Eugenia. It's always interesting. We always compete. We always have this East Coast, West Coast battle of opportunities, and we're looking for investors, but we're very different markets. So I think that investors will look at usually they like coastal markets, and we're coastal markets, and it's. I think thank you so much again for being with us. I have one more thing that I like actually to open for the discussion. Larry and Helen, very interesting in your perspective. What solution would you see in a future for redrawing for places like I was mentioning San Francisco Financial District, for example? What's the use that you will see, or reuse or repurpose of the office buildings, of the retail, and what's the future of cities in general?
I'll let Dr. Larry say something first.
Let's just
put you
call
on
it
a spot,
reanimation. That's okay. Let's call it a reanimation, a re-reality, to the concept of the urban core. We know that office may not be the highest and best use at this point. Maybe vertical labs, in life science could be a solution. Maybe vertical data centers could be another solution. Maybe vertical universities, and educational institutions could be a reality. Maybe vertical, affordable housing. If we had the supply side policies at the federal, state, and local level with community support, and maybe bringing back some version of a redevelopment agency here to provide the gap financing that is necessary to fund these type of projects, along with supply side policies to reduce financing and materials costs. There could be a reanimation of urban living also. I think it could be done, but I look at San Francisco. I was walking around there on Friday, and I was thinking, this reminds me of the 08, 09, the 2001, 2003, for anybody who was still around back then, the 91, 93 recessions. It reminds me of those recessions, and it took us 5, 6, 7 years to get back to where we were in the late 90s and the late 80s and the late 2000 period before the the mid 2000 period before the before the pandemic. It's gonna take time, and I think it's probably gonna take about 10 years.
I absolutely agree with Dr. Larry regarding maybe repurposing. It's like data centers and education. I think that those would be great. I'm not sure if it can be used as like residential purposes, like affordable housing or anything like that. But the main thing, San Francisco will always be San Francisco. That is a gateway for us towards Asia. And I feel like it's going to recover, but a lot of it, I don't like to go into politics, but at the same time, it's a lot of regulations over there that had caused a lot of homelessness, and then criminal activities has gone up, and then all of a sudden, it's a reputation thing now like people hear about it, they don't like going there anymore. So it's really sad to see such a beautiful city. It has the transportation, has the tourism, has the financial economy there, but the people don't feel safe to walk around in San Francisco right now. And I'm sure we can change that, but it does take a lot of effort from the government to help us to change that so that people can go back to San Francisco again. And another last thing is that I do think despite we have gone through this whole COVID thing for almost 2 years now, and then a lot of people are very comfortable working from home. And I've been working from home, for the last decades. But I know for a fact that people still need a human interaction. And then there are a lot of work out there that does need to be in the same area to collaborate. And sooner or later, I feel like people are going to forget. It's like, how do we do that without seeing each other, only seeing each other on the screen? So I do feel like the office side, people are going to go back sooner or later. And talk about those people who say, oh, I'm going to move out of state because I only need to come back a couple days a week. Try to do that every single week, commuting like
It's
that.
hard.
It's not going to last. Yeah.
It is very hard. You're right. And I was just thinking at what you just mentioned about our downtown San Francisco is typically an attraction for international shoppers and diners. That's why they came. So you combine those. You shop till you drop, and then you go and have a nice dinner, right? And we have very nice restaurants. Actually, I think we still do. We have more Michelin restaurants than New York. Sorry, Eugenia, but it's true. In the Bay Area, actually, the entire
I don't
Bay Area,
believe that.
Yes, no, it was true. I'm not sure right now, some closed down, but you know what? The Michelin restaurants survived. They did survive, so it's always this, it's just so funny that but no, New York has lovely restaurants as well, but we still have those restaurants. However, the shopping experience started to lack, and we realized that, and this is what attracts everyone here. So now, not having this international shoppers, which we used to see them all the time in downtown San Francisco, what we would do without them. And my last question will be, because we're almost out of time, is that, and we're doing perfect on timing, just 3 more minutes. Foreign investors, where do you see them coming right now, and what do you see? Very quick.
Oh, where I think once the travel open up, a lot of people are going to come back from Asia. I'm originally from Hong Kong. As you know, that Hong Kong, we have this political climate, and a lot of people are leaving. And no matter what, California is still like this one place that everybody dream about, like they want to invest over here, because especially for our Bay Area with the education and the employment is so strong. And then now we kind of, in a way, Silicon Valley is really getting the name out there now. Reputation is getting better and better. It's a great place to invest. So I do see that
alternative investors to Asia. I would note, actually, Israel will be one. There are a lot of Israelis, cybersecurity companies in Silicon Valley, and maybe UK actually is out of the European Union, definitely looking into our markets. They are still one of the top foreign investors in the US in real estate. So you see that?
Yeah, I do actually. I see some Australian investors who are coming here and they're really scouting right now. So I definitely agree with you on that. And then UK as well, they're going to be really strong in our economy, and also they have confidence that we are going to do better. But I think today I hope that I was able to debunk that myth about how everybody's leaving California as if there's nobody here anymore.
Mm-hmm.
So yeah.
That's not the case. That's not the case for sure. Larry, what do you think, quickly?
And again, I'm a submarket person and a regional person. There are some great submarkets, here in the Bay Area, like the South San Francisco, the Peninsula, East Side, West Side, Santa Clara County. You got the 580 corridor with, plenty of opportunity. You got the 680, going east. There's opportunities out there. And then, in and around Sacramento, is another opportunity. But I like LA, I like San Diego. I like parts of Oregon, around Portland. I like Seattle. And again, I'm a regional person, and I like parts of Phoenix, and if you want to play
Texas?
Universities and medical centers, everybody seems to be going to Austin, so I'm not promoting. The cap rates are more attractive out there. It's a different. I don't necessarily agree with their politics out there, but economics is economics. I'm sure you can find, the right submarket. In Texas, which is, notorious as a commodity market. I don't know if I would be buying apartments in Houston, at these cap rates, but if the cap rates ever adjusted along with the prices and it becomes opportunistic, I'd probably look at it. But, I like California, Pacific Northwest, desert mountain states. And, if you're going to go further east, towards Texas, and I know that South is booming right now in South Carolina, North Carolina, around Atlanta's on fire right now. You got to pick your spots, do your due diligence, underwrite it correctly, and if you see an opportunity, execute on it before the opportunity's gone.
Thank you so much. We didn't even get to China and China coming back and investment back into the US, but that's a completely different discussion another time. So we don't have time for that. You've been wonderful. Thank you so much. I hope that and our audience, which is not necessarily from San Francisco Bay Area, but global and national, has an idea about our market, about the fact that there are still investment opportunities here in the San Francisco Bay Area and Silicon Valley real estate market. I would like to thank Helen Chong, who is the president of CCIM Northern California, and to Lauren Souza, Professor, Dr. CCIM, and many, many other titles. You've been wonderful, and we'll have this recorded. We'll post it everywhere. Will be a great resource of information and educational resource. We'll post it everywhere, and we'll have the recording. And questions from the audience, will you be willing to send your presentation slides?
Absolutely.
Yeah.
Okay. Thank you so much, everyone, and thank you for all who attended, and see you next time.
Okay. Take care.
Goodbye.